Before we dive in, hit subscribe so you don't miss new episodes. If you find value, a quick like helps us reach more people. Let's get started. Today on the deep dive, we're uncovering a hidden vulnerability in wealth management, maybe even for people with millions in assets, and revealing a little-known strategy that's changing the game for art collectors. We're looking at a pretty startling situation highlighted by Art Finance UK, an 8 million part collection owned by a London-based couple that was nearly forced into a distressed auction.
Exactly. It's quite something. Imagine owning this treasure trove of art worth millions, right? And yet you find yourself in a financial bind, really on the brink of having to sell your prized possessions, maybe at fire sale prices. That's the reality this London couple faced. And our mission today really is to unpack their story and understand this often invisible challenge of liquidity. You know, when a big chunk of your wealth is tied up in something you can't easily turn into cash.
Yeah.
We want to explore the alternative financial strategies that could, well, prevent this kind of nail-biting scenario. Think of this as your shortcut to understanding a really critical piece of high net worth finance.
And our guide for this deep dive, it's the insights coming directly from Art Finance UK's report on this.
That's a cautionary tale, isn't it?
It really is.
Okay, so let's get into this case study then. We have this London-based couple sitting on an impressive, what was it, £8 million worth of blue chip artwork.
8 million, yeah, significant stuff.
So on the surface, you know, everything looks pretty good, major assets, but underneath all that, a financial storm was brewing.
And what's fascinating here, I think, is why they were under pressure financially. They reportedly needed capital to refinance a short-term bridging loan.
Ah, okay.
Which is actually quite common, in high-stakes finance. You take out a short-term loan expecting to secure longer-term financing later on.
Sure.
So the logical move, you'd think, would be to leverage their most substantial asset, the art collection. Right. You would think a bank would be, well, maybe not thrilled, but certainly willing to lend against 8 million of valuable art. But this is where they hit the first snag, apparently.
Exactly. They reportedly struggled to secure traditional financing against the collection.
Why is that? It seems so counterintuitive. Surely with 8 million pounds at stake, there must be some mechanism within traditional finance. Are banks just completely unwilling, or?
Well, if you look at the bigger picture with mainstream banking, there are several factors at play. First, banks often just lack the in-house expertise to accurately value fine art.
Okay.
It's not like assessing a house or, a stock portfolio. You need specialists who understand the art market, the artists, the provenance. That history of ownership is crucial.
Like a car's service history almost, proving it's legit?
Kinda, yeah. And the condition, the market nuances. It's a very specific skill set.
So it's basically outside the bank's usual comfort zone.
Precisely. And secondly, there's the risk appetite. The art market, well, it can be volatile sometimes. Now, blue chip artwork, think of those like the blue chip stocks, right?
Yeah.
Well-established, highly regarded.
Generally holds its value.
Generally, yes. But it's still not as liquid or transparent as established financial markets. Banks tend to be pretty risk-averse when it comes to assets they don't fully understand or, frankly, control easily. And finally, there's standard loan processes. They just aren't really designed to handle the complexities of art as collateral.
Okay, so the traditional routes dried up, time's ticking, and the result was they felt forced to consign a big chunk of their 8 million pound collection to auction. Now, for those listening who aren't, art market insiders, why is a forced auction such a risky thing?
That's a really important point about how the art market works. Look, auctions can achieve great results, absolutely. But that's under the right circumstances, strategic marketing, the right timing, getting competitive bidding going.
But a forced sale is different.
Totally different ballgame. The urgency to sell often means you have to accept lower reserve prices for a start. There's less time for that strategic marketing to reach the right collectors.
Right.
And crucially, potential buyers can kind of smell the distress. That weakens the seller's negotiating position. It often leads to below market prices. Suddenly, that 8 million pound collection is vulnerable to a significant loss.
So we see the problem here. This trap of having wealth you can't easily use, it makes you wonder, what's really going on? Which brings us to this key idea in the report, the illiquidity trap. Can you maybe break that down using this couple's situation?
Absolutely. The illiquidity trap is essentially that dangerous spot where you own significant wealth, but it's locked up in assets that aren't easily accessible as cash when you actually need it. In this case, the couple had 8 million pounds in value, literally sitting on their walls, but they couldn't easily convert that value into the capital they needed for that bridging loan. Many people might feel secure knowing they have valuable art, but they're completely unaware that in a crisis, it might actually be more of a liability than a liquid asset. That disconnect. That's really the core insight here.
So high value doesn't automatically mean cash in your pocket. That seems like a huge distinction. It's not like selling stocks with a few clicks, is it?
Not at all. There's the time factor, finding a buyer, negotiating, the logistics, potential auction cycles. It all takes time.
And costs too, I imagine.
Yes, exactly. Costs involved, option fees, marketing, maybe storage,
Yeah.
insurance. All of this takes time and eats into the potential return. And this leads to what the report calls the fallback fallacy.
Fallback value. Yeah, okay, what's that?
It's that mistaken assumption, really. The idea that your art collection or any high-value illiquid asset, frankly, can always be easily tapped as a financial safety net. People think, oh, I've got this valuable collection. I can always sell it if I need cash.
But it's not that simple.
As this couple found out, yeah. Traditional banks often aren't willing to treat it as readily accessible collateral.
And when that need for cash becomes urgent, that's when the real trouble starts.
Precisely. Urgency just erodes value. When you're forced to sell quickly, it signals distress to the market. Buyers are smart. They know a forced seller is probably going to accept a lower offer. You lose your negotiating leverage.
Yeah.
And in the art market, which can be a bit opaque sometimes, this dynamic is even stronger.
Knowing all these pitfalls, it makes you ask, were there other options? I mean, could they have done something else? And that's where firms like Art Finance UK seem to fit in. What did they offer that might have helped this couple avoid that whole pressured auction scenario?
Yeah, this is where the concept of art-backed loans really comes into play as a potential solution. Specialist lenders, like Art Finance UK, they actually understand the intrinsic value of fine art. They have the expertise to assess it and, crucially, use it as collateral for a loan.
Wow, hold on. So they could potentially have skipped that whole stressful auction drama just by borrowing against what they already owned. That's quite an eye-opener. Instead of selling, borrow against it.
Correct. The report highlights several key benefits. First off, immediate liquidity. These specialist lenders can often provide quick indicative terms for a loan secured by the artwork. Typically, you're looking at loan-to-value ratios, LTVs, in the, say, 40 to 60% range.
Okay, so on £1 million artwork, maybe 400 to 600,000 pounds.
Exactly, that kind of range. This could have given the couple the capital they needed to repay their bridging loan without selling a single piece.
That sounds like a massive game changer right there. Instant relief from the pressure. And the other big benefit you mentioned is preserving the collection.
Absolutely.
Yeah.
They get to keep ownership of their art. The artwork acts as collateral, sure, but it stays with them, maybe in secure storage managed by the lender or a partner, but it's still theirs.
Right.
No need for that rushed, potentially damaging sale.
Right.
Plus, these art-backed loans offer time and flexibility. They could have structured a manageable repayment plan. Maybe they decide later to strategically sell just one piece on their own terms to repay the loan. Or maybe they repay it through other financial means entirely. It gives them options.
And for high net worth individuals, I bet discretion is a pretty big deal too.
It is, definitely. Specialist lenders get that. They understand the need for privacy.
Yeah.
The entire process, from the first chat to the final loan agreement, is handled confidentially. You avoid all the public scrutiny and potential speculation that comes with a distressed auction.
Okay, so art-backed loans sound really promising. But for listeners thinking, could this apply to me? What are the key things they need to know about these kinds of loans?
That's a crucial point. This isn't like strolling into your local bank for a personal loan. There are specifics. Firstly, the eligible assets. Lenders typically focus on high-value works.
Right.
By established artists with a strong track record in the market and really clear provenance that documented ownership history we talked about.
So paintings, sculptures.
Usually paintings, sculptures, sometimes important drawings or limited edition prints by recognized names. Across different periods, too. Old masters, impressionist, modern, post-war, contemporary art.
So, my collection of holiday souvenirs probably wouldn't cut it.
Brief chuckle sound implied by tone. Probably not in the same league, no. Unless maybe Picasso sketched one for you.
Ah, fair enough. Okay, so you got the right kind of art. Then there's the actual loan process. The report outlines it step by step, starting with, what, an initial chat?
Yeah, the initial consultation. Discussing the client's needs, their collection, the options.
And then the valuation part, getting the art appraised.
Exactly, that's a critical step. Usually done by independent experts to figure out the fair market value of the specific artwork being used as collateral.
Who are these experts, like the appraisers you'd use for insurance?
Often similar types of specialists, yeah.
Mm-hmm.
Deep knowledge of the art market. Based on that valuation, The lender provides indicative terms, the loan amount they're proposing, the interest rate, the loan term, all that.
Then comes the paperwork, I assume.
Right.
Due diligence.
Yep, due diligence follows. That includes verifying identity, KYC, know your customer checks confirming you actually own the art, proof of ownership, ensuring there's clear title, so no other claims against it.
Standard stuff for finance, really.
Pretty standard, yes. Then comes the formal loan agreement. That outlines all the terms and includes the security agreement, which details the lender's claim on the artwork until the loan's repaid, a bit like the paperwork for a mortgage on a house.
Got it.
And finally, once everything's signed and the logistics, like secure storage, are sorted, the funds are dispersed.
The report also mentioned different types of art finance, so it's not just one standard loan.
Not at all, no. There are short-term loans, which, as we saw with the London couple, are great for breaking those immediate liquidity gaps. But there's also longer-term financing that can be used to unlock capital for other things, maybe new investments, business ventures, even for estate planning purposes.
Interesting.
Some lenders offer revolving credit lines too, so ongoing access to capital against the collection's value, and even acquisition finance, helping collectors buy new pieces.
It really sounds like navigating this requires some specialized knowledge. The report emphasizes getting expert help, right? And what about things like those loan-to-value ratios? Is there room to negotiate?
Absolutely. Partnering with experienced art finance specialists or brokers is really vital. They understand both the art market and complex financial structuring. They can help find the right lender, negotiate the best terms possible.
So they can advocate for you.
Yes, they can advocate based on the specific artwork, current market conditions, things like that. While LTVs often fall in that 40–60% range, a good broker can definitely push for the optimal terms. And it's worth mentioning, some firms in this space might operate under FCA oversight, the Financial Conduct Authority, which adds a layer of regulatory comfort for some clients.
This whole discussion seems to point towards a more, strategic way of thinking about art collections. It's not just about having nice things on the wall, is it? The report talks about integrating art finance into wider wealth management.
Exactly. This is where it moves beyond just crisis avoidance. For sophisticated investors, art can be seen as latent capital. It's just sitting there.
Potentially. Latent capital, I like that.
Instead of just sitting there, it can be strategically leveraged. Create liquidity for different opportunities without having to mess with your core investment portfolio. Use an art loan to fund a new business idea, or jump on a time-sensitive investment.
So unlocking the value without actually having to sell the asset permanently?
Precisely. And it can be a tool for diversification or rebalancing your overall wealth, too. Say you want to invest in another asset class, but it's a bad time to sell your art. An art-backed loan gives you that capital.
Makes sense.
The report also flags its use in estate and tax planning, offering ways to manage estate taxes or maybe transfer assets to the next generation more efficiently. At the end of the day, it just enhances overall financial flexibility. It gives high net worth individuals more control over their entire balance sheet.
So the big takeaway here, it seems, is that owning valuable art doesn't automatically mean you have financial flexibility, that illiquidity can be a serious risk.
Yes.
But the rise of specialist art finance offers a way to turn those, static assets into more dynamic capital.
That sums it up perfectly. The case of the £8 million collection really drives that point home. It highlights the need for proactive financial planning that actually considers all your assets, including those passion assets like fine art.
Thanks for breaking all this down for us. It's definitely given me, and hopefully our listeners, a new perspective on managing wealth tied up in tangible assets.
My pleasure. It's a fascinating area, really, where art and finance intersect in increasingly sophisticated ways.
Thanks for listening. If today helped or made you think, hit like it tells the platform this content matters, and tap subscribe if you haven't already. See you next time.